With the end of 2024 rapidly approaching, now is the time for real estate investors and business owners to start making their final moves of the year to substantially reduce their taxes. So in this video, we're going to be going through the top 5 strategies that business owners and real estate investors can use to reduce their taxes before the year ends. Hi, my name is Thomas Castelli, and I'm a CPA and tax strategist who's helped hundreds of real estate investors and business owners navigate the tax code to reduce their taxes. If you do like this video, make sure to hit the like button as well as the subscribe button and the bell icon so you don't miss out on future tax savings videos. All right, so the top 5 strategies we're going to be covering today are the real estate professional status, buying a business vehicle, business expenses, so you want to accelerate some of those business expenses if you can, retirement accounts, HSAs, and tax loss harvesting. So let's get into the first one, the real estate professional status. If you qualify as a real estate professional, that means that you can use the losses generated by your long-term rental properties to offset your W-2 active business income and other forms of non-passive income for substantial tax savings. Now, if you don't already qualify as a real estate professional, doing so before the year ends might be a stretch. But if you already are a real estate professional, you might be able to purchase another property before the year ends and use the losses that are typically generated by the non-cash expense called depreciation to significantly reduce your tax bills. Now, to do this, you need to purchase a property before the year ends and place it into service. Placing it into service means the property is rent ready and available for rent, which is typically demonstrated by listing the property for rent. It's important to note that you do not need to have a renter in before the year end. It simply needs to be placed in service. Now, this is not the case for short-term rentals. We're not going to be covering that in this video, but it's important to note that if you do own short-term rentals, that you need to have at least a few guests stay at your property to make that work. But if you're a real estate professional, you don't need to worry about that. You just need to get the property placed in service, and there's still time to make that happen before the year ends. The next one is going to be buying a vehicle, using it for business purposes, and using bonus depreciation to create a non-cash loss that you can use to offset your business or real estate income. So in order to make the strategy most impactful, you have to first buy a vehicle that has a gross vehicle weight rating of 6,000 pounds or more, and these are typically trucks or SUVs. The next component here is you need to use it more than 50% for business. Here's a quick tip. If you can purchase the vehicle close to your end, maybe in November or December, and drive it exclusively for business purposes, or in other words, 100% for business purposes, you're going to be able to maximize this deduction. And that's because this strategy is based on the business use percentage. For example, let's just say you bought a truck for $100,000 and used it only 50% for business purposes. So that means you'd be able to deduct $30,000 on your tax return. However, if you were to use that vehicle 100% for business purposes, you'd be able to deduct $60,000. So maximizing your business use percentage is critical for the strategy, and if you could purchase it close to year end, it's a lot easier to get 100% business use. Now, the key thing here is you do need to use it more than 50% for business for the next 5 years to avoid recapturing any of the tax benefits you took in the first year that you owned the vehicle. Now, last thing I want to note here is that you should only really purchase a vehicle if you actually need one. You don't want to be throwing away money just for tax savings. All right, now the next one is going to be accelerating certain business expenses. Now, if you're going to be purchasing some equipment in 2025, you may want to consider purchasing that before the end of 2024 because you can deduct that using the de minimis safe harbor or perhaps using bonus depreciation depending on the type of equipment that you're going to purchase. Now, some other expenses you might want to consider prepaying include insurance, subscriptions, utilities, and even the first month's rent for next year. So the next one is going to be retirement accounts. Now, it's important to note that if you have a 401k through your company, or perhaps you have a solo 401k if you're self-employed, you need to make the employee portion of the contribution before 12/31/2024. You cannot make that contribution after the year ends. However, the employer portion of the contribution, and this is particularly important to note if you are self-employed, can be made after the year ends. So if you have an IRA, you don't have to make the contributions before year end, which could be a good thing. You have until 4/15, which is the tax filing deadline for individuals to make those contributions. So that's just important to note. Now, when it comes to an HSA, as long as you have the HSA open before the year ends, you can make those contributions after the year ends up until 4/15. The same with IRAs, as long as the HSA is open before the year ends. So if you're considering a health savings account, also known as an HSA, you're going to want to go ahead and make sure that account is open before the close of the year. Now, the last one we're going to cover in this video is tax loss harvesting. Tax loss harvesting typically involves selling capital assets such as stocks, most commonly, if you have them in a loss position, to lock in the capital loss this year so you can use those losses to offset other capital gains that you might have, or you can use up to $3,000 of capital losses to offset your ordinary income, such as income from your W-2 or active trader business. Just be aware that you can't repurchase these stocks within 30 days, otherwise you will lose the ability to use the capital losses. And also just be careful that those stocks might not go on a rapid run or recover if you do wish to buy them back. All right, so those are the top 5 strategies that you can use before year end to maximize your tax savings. Did we miss any? Do you have any questions? Go ahead and drop them in the comments. We're going to go ahead and answer as many comments as we can. And remember that if you like this video, to hit that like button and the subscribe button, as well as the bell icon so you don't miss out on future tax savings videos.